Please come to this wonderful question number 33. Question number 33. On 1st October 2016, A Limited entered into a contract for purchase of machinery from ABC Inc., a company in USA, for $50,000. Made an advance payment of $10,000 as on that date. So, what is the cost of this machinery? 50,000 USD. And to buy that, you need to pay some advance payment of USD 10,000 as on that date. The machinery installation was complete on 31st December 2016. The terms of the payment were $10,000 on installation and balance with a 6-month credit period, that is on 30th June 2017. How would you account for the foreign currency transaction in the books of A Limited, assuming the exchange rate is as given below? So on 1/10/16, what is the importance of 1/10/16? You have made an advance payment of USD 10,000, right? Rate was 40 rupees per dollar. 31/12/16, the machinery was installed. So on this date, you will recognize the property, plant and equipment. 31st March 17 is probably the year ending date, and 30th June 17 when the balance payment was made. Question is, how would you account for the foreign currency transaction in the books of A Limited, assuming that the exchange rate was as given below? So advance payment will be initially recorded at 40. The question is, will you revalue this advance given on 31st December when the machine was installed? No. At what rate machine will be valued at? 40, 42, 45, 44, 42. Sure. Yes. So write down a small note on this. So question is tricky because this standard is not very clear about the advance payment. So there is a note which we will write. A foreign currency transaction should be initially recognized at functional currency at spot exchange rate, should be initially recognized in functional currency at spot exchange rate, that is at the transaction date exchange rate, that is at the transaction date exchange rate. What is the meaning of transaction date? Right, the transaction date is the date. Transaction date is the date when a particular item is eligible for recognition. When a particular item is eligible for recognition in the financial statement, is eligible for recognition in the financial statement. In the given case, since the installation of machinery was completed on 31st December 2015, the transaction date for the purposes of IAS 21, the transaction date for the purpose of IAS 21 is 31st December 2015. The transaction date for the purpose of IAS 21 is 31st December 2015. Written? Now write down note. A guidance is given by the IFRS Interpretation Committee. A guidance is given by IFRS Interpretation Committee, which states that in circumstances in which an entity pays or receives some or all of the foreign currency consideration in advance, some or all of the foreign currency consideration in advance of the recognition of the related asset, expense or income, the entity generally recognizes a non-monetary asset or liability. The entity generally recognizes a non-monetary asset or liability. The entity generally recognizes a non-monetary asset or liability. So it means that advance given was a non-monetary asset or liability. So next line, write down the non-monetary asset represents an entity's right to receive goods or service. The non-monetary asset represents entity right to receive goods or service. Into bracket, write down a prepayment asset. Full stop. Some lines I will delete in discussion. Then write down this prepayment asset is subsequently derecognized. This prepayment asset is subsequently derecognized. This prepayment asset is subsequently derecognized when the related asset is recognized in accordance with the relevant standard. Full stop. Next line. Subsequently, when related asset is recognized, the same exchange rate is used. On initial recognition of the related part of the asset. Same exchange rate is used on the initial recognition of the related part of the asset. Okay, full stop. No exchange gain or loss arises in respect of the advance consideration. No exchange gain or loss arises in respect of the advance consideration. on the recognition of the asset. On the recognition of the asset. Full stop. So what have you understood from this on recognition of the asset? Now in this question, after this interpretation committee note, what we will do, this asset will be recognized. Total value is 50,000. 10,000 will be multiplied by 40 and 40,000 will be multiplied by 42. And later on, whenever you will settle the liability, that will be treated as exchange difference. But on this 10,000, no difference will arise. So that was the intention of this question. How to account for an asset when there is an advance payment made. Advance payment is a non-monetary asset, so that will not be subsequently remeasured. The related asset, income or expense will be part valued at that rate. Remaining part on the date of recognition of that asset. Now we will take one important paragraph. Change in functional currency. Can functional currency change? Yes. Functional currency is determined by the indicators, primary indicators, additional indicators. Once these indicators change, the environment change, the primary economic environment in which the entity operates changes, then the entity may be required to change its functional currency. Okay. We are accountants. Can we stop a company from changing the functional currency? No. So what we will do, we'll have to apply accounting principle here. All items are translated into new functional currency on the date of change of functional currency. So functional currency may change from dollar to euro. So first to prepare your financial statement in this currency, dollar, and then convert all the items into euro. Is it right? Next important point, any change will be given prospective effect. What is prospective effect? Don't go into the past now. Okay. And this line becomes important for those non-monetary items which are carried at historical cost. Suppose the date of change of functional currency is 1st July 2020. Is it right? And there are some property, plant, equipment item. This property, plant, equipment item was earlier valued at 10,000. It was valued using cost model. So it is appearing at 10,000. Now you convert into euro on this date, using this date rate, not the rate when the asset was purchased. That is the meaning of that you will not give retrospective effect. Today what is the rate? Apply that. And let us say this becomes, for example, 8,000 euro. Applying the rate of exchange on date of change, not the date when the asset was acquired. And this will become the deemed cost. This will become deemed cost for all further accounting. Is it right? That means you suppose this asset was originally purchased 10 years ago on 1/7/2010. Now this is of no relevance to us. Today, whatever is the rate will be applied and converted, and this becomes the deemed cost. So 8,000 and then subsequently 8,000 will be depreciated. For example, the translated amount to the new functional currency on the date of change will be taken as the historical cost for the non-monetary item. Now see, there is one case study also, small case study, how the functional currency changes in practical life. A practical example, there is a company called A located in Germany, and it is a wholly owned subsidiary of a company called Z. So Z is parent and A is subsidiary. Z is parent, A is subsidiary. Then second line, dollar is the Z's functional currency. Parent's functional currency is dollar. Euro is functional currency of A because all sale, purchase and labor cost were in euro. So right now what is the functional currency of A? Euro. But then there is a change in business model. Understand, Z started using A's facility to meet its order. What is the meaning of this line? Now A seems to be a manufacturing unit. So Z's business has increased. So it is asking A, I am going to use your facility only to meet all my orders. So A closed down its sales department because A has limited capacity. Now that capacity will be used to meet Z's order. So do you need a sales department now? No, because 80% of its output will be supplied to Z only. So sales department has been closed down. Z built a new facility to produce material required in its manufacturing process, and Z started receiving all material from A. So A will supply its almost 80% output to Z. Z will use it for manufacturing material. A now expect cash inflows and outflows except for wages in dollar. So now earlier what was the main inflow and outflow? In euro. Now because of the change in the business model of subsidiary, the maximum inflow outflow would be in dollar except wages which will be paid in local currency euro. Now the question in the exam would be, will A change its functional currency? Can A change its functional currency and why? So you will write this answer. Currency of revenue has changed from euro to dollar, and it seems to be a permanent change because the sale department has closed down. Currency of outflow and inflows have changed from euro to dollar. Position of A within Z's overall operating strategy has changed from a self-supporting standalone entity to a manufacturing facility of Z. Earlier, A had lot of autonomy. It was selling, buying, incurring cost in its own currency. It was a self-sufficient unit. Now it is to a large extent just an extended arm of Z. It is just carrying out manufacturing activity on behalf of Z. So the status of the subsidiary A has changed from a self-sufficient entity to an extended arm of Z. Therefore, it will be more appropriate to change the functional currency from euro to dollar. Right? So that was a note on functional currency change. All items will be converted at exchange rate on the date of change. And in case of non-monetary item, those rates become the historical rate for subsequent accounting. Practically, this is a very rare situation, okay? But again, possible. So the standard setter has to keep in mind all these points. Now, presentation currency being other than functional currency. Possible? Very much, especially when the group entity system is there. The subsidiary, associate, joint ventures may be in different countries. Their functional currency may be different. They have to be converted into the presentation currency of the parent so that consolidated financial statement can be prepared. Even in separate financial statement also, a company's functional currency and presentation currency can be different. Like a company's functional currency is dollar because receipt, payment, funding is in dollar, but Indian regulation require that you must present your financial statement in INR. That is also possible. So presentation currency of the reporting entity may be different from the functional currency, as also the functional currencies of the entities within the group. In those cases, transactions recorded in functional currency are subsequently translated into the presentation currency of the reporting entity. Is it right? So what we have to do, we have to now learn the rule of conversion from functional currency into presentation currency, and there will be some exchange difference also in that process. That exchange difference, again, what will be the treatment, we will see. No, I will tell you. First you tell me one answer. Grand International, is this question there? Question number 22. Grand International is established in Germany but has extensive dealings in UK. The following details are available. Currency of the primary economic environment in which the entity operated is euro, and it presents its financial statement in pound. What is the presentation currency and functional currency of Grand International? Fill in the blanks. Presentation currency dash pound. Functional currency euro. 10 marks. I hope they ask such questions. Okay. Now, translation of rule of conversion from functional currency to presentation currency. On translating from functional to presentation currency, the entity's financials, including comparatives, are converted at falling rate. Including comparatives are converted at falling rates. What is comparative? Previous year, comparison purpose. Assets and liabilities will be translated at closing rate. Income and expense will be translated at exchange rate on the date of transaction. However, average rate can be used. One more line you add there. The standard is silent about capital and reserve and surplus, capital and other equity items. This only talks about the standard. At what rate assets and liabilities, income and expense will be translated. But what about capital and reserve? Capital and reserve, the standard is silent, so we will take earliest rate available, or in case of consolidation problems, rate on the date the control was obtained. So if you are given the financial statement of a subsidiary and you have to convert into the presentation currency of the group, then asset and liability closing rate, income and expense, either if a possible exchange rate on the date of transaction, otherwise use average rate. But what about the capital and reserve which will be appearing? Date on which control was obtained. Now what happens? You are using three different rates. One is your closing rate, average rate, rate of exchange on the date of control. So will this converted financial statement automatically tally? It will not tally. Now understand two things. Just write a note here. IAS 21 is silent for this. This is our creativity. Then why it is silent? Because if you use any other rate also, their logic is that your total of capital and reserve will remain the same. Because if you use a different rate, difference will arise. difference will again go to equity only. So finally, for capital and reserve, whatever rate you use, the final equity of the entity will be the same. The total equity will remain the same, because as you change the rate, difference will arise. Difference will again be transferred to FCTR only. Okay. So therefore it doesn't matter as per the standard. But you are the student, you have to solve. So take this rate, if at all they ask you. The resulting difference as a result of above conversion is transferred to OCI under the head foreign currency translation reserve. Okay. So today one more time we are coming across OCI. When you convert from functional currency to presentation currency, exchange difference will be transferred to OCI, and you can give it a name of your choice. Let us call it foreign currency translation reserve. Then the question is, why not in P&L account? The answer is that it is not recorded in P&L account because it does not affect the cash flow from operations. It is just a book entry, just an accounting adjustment. It does not affect how your cash flow from operations are generated. In case if you are preparing the CFS and FCTR arises, then that FCTR will be distributed between parent and non-controlling interest in the respective ratio on consolidation. Okay. Normally in exam, the consolidation of foreign subsidiary is not asked. Okay, but if asked, then this paragraph will be useful to you. Now come to one question which is printed, I think, at the end. Question number 34. Question 34, simple question, just for understanding the concept, application of the concept. ASF statement of financial position as on 31st March 2020 is as follows. Assets, non-current asset, all assets and liabilities now, without distinguishing between monetary and non-monetary. So all these assets will be translated at which rate? Closing rate, which is 69 rupees per dollar. Equity and liability, share capital, earliest rate available, 60 rupees per dollar. Opening reserve, earliest rate available. Profit for the year, average rate we will take. Current liability, closing rate we will take. ASF wants to present its financial statement in dollar. So what is their presentation currency? Dollar. Functional currency, rupee. Opening rate was 60, average rate is 63, closing rate is 69. So what you do, dear student, you prepare the statement of financial position in dollar on your own. Your balance sheet will not tally. If your statement of financial position does not tally, then under the head reserve and surplus, you'll open one more line item, FCTR. FCTR balancing figure in reserve and surplus. Try, I will give you 10 seconds. I'll just come in 10 seconds, try. Okay, now we will check the answer. See, first check PPE 11594, inventory 2899. Have you multiplied or divided? Divided. 15942. Total of the asset side 30435. Equity and liabilities. Share capital. Earliest rate available or date of control. So earliest rate 16667 you are getting. Reserve and surplus. Opening balance. Opening rate 1667. P&L account current year means it is a net effect of income and expense. So average rate 3175. 3175. Current liabilities. Current liabilities 11594. Current liabilities 11594. Is it tallying? No. You will find there is a difference. So that difference you write down as a separate line item, foreign currency translation reserve, balancing figure 2668. Balancing figure, right? Balancing figure 2668. Then same exercise you will perform if it was a subsidiary company, and this financial statement will be used for consolidation purpose. And if there is a NCI, then this FCTR will be allocated between NCI and parent company. Okay. Come back to your theory part. Translation of foreign operation. Foreign operation, that is subsidiary branch, can be in the functional currency of the foreign operation as discussed above for the determination of functional currency. So it means functional currency of subsidiary, branch, associate can be different from the functional currency of the reporting entity. Later, the results of such operations have to be translated into the presentation currency of the reporting entity at the end of the reporting period. You can't prepare a consolidated financial statement which has dollar and rupee. So you have to bring it into the presentation currency of the reporting entity at the end of the period, and exchange difference arising on such translation of foreign operation are to be recognized in OCI only. So you have already discussed that. Now translation of foreign operation. Foreign operation, that is subsidiary branch. Is it a repetition? Okay, just see the summary. Assets and liabilities. Closing rate on the date of SOFP. Income and expense. Exchange rate, alternatively average can be used if there is no significant fluctuation. Exchange difference will be recognized in other comprehensive income only. So that is about conversion of foreign operation financial statement into presentation currency of the reporting entity. Now, elimination of intra-group transaction involving a foreign operation. This is what we do in consolidation. In consolidation, what do we do? If there is a debtor, if there is a creditor, so while doing the consolidation, intra-group receivables and payables are eliminated. Bills receivable, bills payable, eliminated. Loan given, loan taken are eliminated. But then there is a small problem here. You will eliminate the assets and liabilities, but what about the exchange difference? Exchange difference will remain. Exchange difference will remain in the process of consolidation. Why exchange difference will remain? Because ultimately you are going to settle it separately, and whenever you are going to settle it, the exchange difference is going to arise. So in CFS, elimination of intra-group transaction involving foreign operation will not eliminate the exchange difference arising on such transaction. Now first, to understand how the exchange difference will arise. Parent company, subsidiary company. Parent company, functional currency is dollar. Subsidiary company, functional currency is, let us say, rupees. This is dollar. Okay. Then subsidiary company sold to parent company $1,000, and assuming that the transaction has not been settled. So what is appearing in the books of parent company? $1,000. When it was sold, the rate was 60 rupees. At the end of the year, the rate is 61. So what they will do? They will pass two entries. First entry will be subsidiary account debit 1,000. Purchase account debit 1,000 to subsidiary account 1,000. Right? Purchase to subsidiary 1,000 into 60. Because for parent, dollar is a foreign currency. To subsidiary, that is amount payable 60,000. At the end of the year, they will pass the entry. Exchange difference account debit 1,000. 1,000 into 1 rupee difference. And to subsidiary account 1,000. What entry this subsidiary will pass? Only one entry. Parent account debit to sales account $1,000, because their currency is dollar. Will they also do the translation at the end? No. Now I am preparing consolidated financial statement. So in consolidated financial statement, parent will be cancelling the amount due from subsidiary, and parent will cancel the amount receivable from parent. These two account will be cancelled. Receivable and payable will cancel, whatever may be the amount. Is it right? That party is showing $1,000, this party is showing 61,000 payable. Cancel it. But this exchange difference will remain. This exchange difference will remain. Now this exchange difference can be in the books of parent or it can be in the books of subsidiary. Yes or no? That is also possible. Parent may have sold goods of 1 lakh rupees to subsidiary. So parent will record in rupees. Suppose they want to record the invoice in rupees. So parent will have no exchange difference. But then subsidiary will have exchange difference because they will have to convert rupees into dollar. So exchange difference, whether in the books of parent or subsidiary, will remain. Now what is the treatment of this exchange difference? What is the treatment of this exchange difference which is arising on the intra-group transaction? Now here the answer is, in consolidated financial statement, such exchange difference will be recognized in P&L account. Now there are two things we will understand. If it relates to, if it does not relate to, does not relate to net investment in foreign operation. If it does not relate to net investment in foreign operation, then such exchange difference will be recognized in P&L account. But if it relates to a monetary item that forms part of entity's net investment in foreign operation, like for example, parent may have given a loan to subsidiary which is not expected to be repaid in the future, then again that is a monetary item, so they will have to retranslate it. Is it right? If parent, suppose I remove this example, everything I am removing, parent has given loan $1 lakh to subsidiary. Subsidiary has received 1 lakh loan from parent, but for parent this is a foreign currency. At the end of the year they will translate it, so that will give rise to exchange difference. Let us say exchange difference rupees 1 lakh, 1 rupee difference has arisen. But this loan in substance is a net investment in subsidiary. It is as if this loan is like an equity because its repayment is not planned. Then the standard says it is more like an equity. In substance it is like an equity. In form it looks like loan, but in substance it is equity, because if repayment is not planned, then it is like an equity. You are just funding that entity. Instead of giving equity, you give them loan. Then they are saying that this difference will be recorded in OCI and reclassified from equity to P&L account on the disposal of the net investment. So this time what you will do, if it relates to net investment in foreign operation, then OCI first, and from OCI to P&L account on disposal of this net investment. So whenever this loan will be derecognized, you will also transfer this balance from OCI to profit and loss account. So till that time you accumulate in the OCI only. Is it right? So right now the topic going on is foreign operation. First we have learned how to convert the financial statement of foreign operation into presentation currency of the reporting entity. Then we learned in the process of consolidation, eliminate the intra-group receivables and payable, but do not eliminate the exchange difference. Exchange difference relating to other items will go to P&L account, and exchange difference relating to net investment in foreign operation will go to OCI. Again, in the process of consolidation, goodwill will arise. Yes or no? Goodwill. What is the formula for calculating goodwill? You know. You have learnt in your business combination chapter. Goodwill means you will compare the consideration paid with fair value of identifiable net asset, and the difference is goodwill. Okay. Consideration is paid by whom? Parent. Consideration is paid by the parent, so goodwill will be first assumed that, understand, goodwill will be assumed as an asset of the foreign operation. Goodwill will be assumed as an asset of the foreign operation, and consequently this is translated at closing rate to the presentation currency of the reporting entity, and the difference is treated as exchange difference of foreign operation. So what is the rate at which goodwill will be translated into? So every year goodwill will be translated at closing rate of the presentation currency, and the difference will be treated as exchange difference of the foreign operation. Again difference, no? goodwill is treated as a part of asset of the foreign operation. That is the logic. This goodwill you have acquired or paid for when you acquired the foreign subsidiary. So therefore it is treated as a asset of the foreign subsidiary. And then what is the rule for asset of the foreign subsidiary? Closing rate. Again, next rule, exchange difference goes to FCTR. Exchange difference will be transferred to FCTR in case of translation of foreign operation into presentation currency of the reporting entity. So this is what the standard says. Treat the goodwill also as an asset of the foreign operation. Now we'll solve a small example. The logic they have given, I hope, little bit convincing that it is an asset of the foreign operation. It is not your asset. This asset was acquired only when you acquired the subsidiary. Okay. So therefore, apply closing rate and apply the exchange difference to same treatment FCTR. Now we'll solve a small example printed at the end. Question number. What is the question number? 35. Number. Very easy problem because most of the things they have already done. Global Limited has a functional currency of USD and needs to translate its financial statement into the functional and presentation currency of Infotech Limited, whose functional currency is L dollar. This is their functional currency. This is USD, this is L dollar, whatever is that. The following is the statement of the financial position of Global Limited prior to translation. Now this is the functional currency USD and I have to convert into this currency L dollar. What they have done to help you, issued capital they have already converted. So don't convert yourself. Opening retained earning they have already converted. And then the rest. Translate the statement of financial position of Global Limited into L dollar. This is a currency. Okay. In many countries they add this dollar. For example, Australian dollar. They write A dollar. For consolidation by Infotech, share capital and retained earning are already pre-populated. That means they have already been converted. So do not convert these two items. What are the relevant exchange rate? Beginning of the year, USD 1.22 is equal to 1 L dollar. Average rate USD 1.175 equal to 1 L dollar. And closing rate 1.13 equal to 1 L dollar. You are converting from USD to L dollar. Will you multiply or divide? Divide. Why? Divide. Mathematics. Is it right? So that's a small care you have to take because I have seen students who instead of dividing they multiply also. So see the answer. Again your financial statement may not tally. So the difference you will treat it as FCTR. Write down. Same question, write again. Property, plant, equipment. Rate applied. Closing rate 1.13. Correct? Closing rate will apply. So calculation is, trust me, 44248. Is it right? Or you want to check? Check. Receivable 9,35,000, closing rate 1.13. Check, is it 827434? Take total of the asset side. Take total of the asset side. Is it 871,682? Then issued capital. Now in issued capital you just write down directly 30055. 30055. And opening retained earning also write directly 15274. Then profit for the year take average rate. Profit for the year take average rate 1.175. Just check the answer. Is it 17021? Then accounts payable take closing rate. Accounts payable take closing rate. $1.13, 743, 363. Accrued liabilities 47,000, 1.13 closing rate 41,593. And balancing figure write down FCTR. What is balancing figure FCTR? OCI 24376. $871,682. Come to question number 43. 4343. The functional and presentation currency of parent P is USD. And the functional currency of the subsidiary S is Euro. Right? Functional currency is clear. For parent P it is USD, for subsidiary it is Euro. P sold goods having a value of USD 100 to S. When the exchange rate was USD 1 is equal to Euro 2. So when the sale was made, the rate was 1 USD equal to 2 euros. At the year end, the amount is still due and the exchange rate is 1 USD equal to 2.2 euro. How should the exchange difference be accounted for in the consolidated financial statement? So will the exchange difference still appear? Yes. Intercompany dues will be eliminated, but exchange difference will still appear. So first you tell me, in which currency the invoice was made? USD. So it is in the functional currency of the parent. So will they need to convert? But the subsidiary whose functional currency is euro, they will need to convert. They will first convert USD into euro. At the end of the year also they will convert the payable into closing rate. Parent company need not do anything except it will record the sale entry. So now in order to have a little better understanding, what we'll do, first we'll write 2-3 journal entries and then we'll read that note. That note gives you full explanation. Note I will read, but interested student can write in the notebook properly. Journal entries in the books of P Limited in bracket SFS. So what entry they will pass? S Limited account debit to sales account 100 $100 because their functional currency is dollar. Invoice is in dollar. Now write down in the books of S Limited SFS. In the books of S Limited SFS, two entries will write. First, one entry, purchases account debit to P Limited dash creditor. Purchases account debit to P Limited dash creditor. They will convert USD into Euro. 1 USD is equal to 2 euros. So 100 USD is 200 euros, 100 into 2. But in their books, creditor account is a monetary item. So they will restate the creditor at closing rate. Now the exchange rate has gone to 2.20 euro per dollar. So that means now the creditor will be valued at $220. 220 minus 200, $20, a 20 euro loss. So exchange loss in bracket P&L account in separate financial statement. They will transfer it to P&L account to P Limited. 20. So how will it appear in their respective SFS? So write down SFS of P, extract, current asset, trade receivable, S Limited $100. Then write SFS of S Limited, liability side, reserve and surplus under that P&L account or exchange difference, 20 euro loss, and current liabilities trade payable, P Limited, 200 euros payable. This is what they have done in the respective SFS. Now we have to answer how the exchange difference will be accounted for in the CFS. So, 220, typing error, write 220 here. This is receivable, this is payable, and it is the same thing. What you have to receive is equal to what they have to pay. These two will be nullified. This two I will not write. But this 20 will still appear in the CFS as an exchange loss. Okay. So in the CFS, write down CFS of P, trade receivable 100 and trade payable both in the same currency, 100 cancelled. And in other equity, profit and loss, exchange loss will appear. Is it related to net investment in foreign operation? No. It is just a normal sale transaction, short-term arrangement. So therefore, this will appear at in the end in the CFS. But because this 20 is in euro, financial statement is in dollar. So this will be converted at the closing rate. .909, because this liability was converted at the closing rate only. Now we'll read that note. So whenever you have doubt, you can read the note also. This is understandable. At the year end, S should revalue its accounts payable to euro 220. Recognizing a loss of 20 in its standalone profit or loss. Thus, in the books of S, the balance payable to P will appear euro 220. In the books of P, the balance receivable USD 100. For consolidation purpose, the assets and liabilities of S will be translated at USD at closing rate, that is USD 100, which will get eliminated against the receivable in the books of P. But The Euro 20 exchange loss recorded in subsidiary statement of profit and loss has no equivalent gain in parent's financial statement. Euro 20 will remain in the consolidated statement of profit and loss. The reason for this is that the intra-group balances represents a commitment to translate euro into USD. So the group as a whole has an exposure to foreign exchange risk. So there is a risk this group is taking, because whenever they will settle this, exchange difference will arise. Now, dear student, come to one question number 36. One more practice without answer now. Question number 36. H Limited functional currency is INR. Sold goods to H Limited, subsidiary of H Limited, for $15,000. Spot rate is rupees 61 per dollar. The debt is still outstanding, DEBT. The debt is still outstanding on the reporting date. Closing rate is 69 rupees per dollar. Past journal entries show SFS and CFS extract. So first let us understand SFS. In SFS, who will pass the entry? H Limited sold goods to S for $15,000, but the functional currency is INR. So this problem, H Limited will have to record the exchange difference. So write journal entries in the books of H Limited. Write neatly. Should be able to read later on your own. First entry, write down H Limited debtors account debit to sales account. Remember all these adjustments in case if they ask you a consolidation of a foreign subsidiary. So that time it will be useful to you. To sales account 9,15,000. And then second entry, write down year end. Now the rate has gone from 61 to 69. S Limited debtor account debit to exchange difference in bracket P&L account. To exchange difference 1,20,000. Done. Then write down in the books of S Limited. What is the functional currency of subsidiary? Dollar. And even the invoice is in dollar. So for them it is just a simple purchase entry. Purchase account debit to H Limited, creditor 15,000. Will they also do the revaluation at the end? No. It is their functional currency only, not a foreign currency. Now write down SFS of H Limited. SFS of H Limited profit and loss statement extract. Profit and loss statement extract. They have specifically asked you show SFS and CFS extract. Revenue from operation dash sales 9,15,000. Other income dash exchange difference gain 1,20,000. Then write down SOFP. Balance sheet means statement of financial position. Asset side, trade receivable. How much trade receivable will appear? 10,35,000. in rupees. RS means rupees, or also called INR, Indian rupees. Now come to SFS of S Limited. So they will write only one item, expense, in the P&L account, $15,000. Is it right? Expense $15,000. Say yes, yes. And what about their SOFP? Current liabilities trade payable $15,000. Current liabilities trade payable $15,000. Parent company is H Limited. We are preparing now CFS of H. In CFS of H, this receivable and payable we will cancel. Receivable and payable we will cancel. What will remain? The exchange difference will remain. And this is related to items other than net investment in foreign operation. Okay? A short-term trade receivable cannot be said to be net investment in foreign operation. So therefore the exchange loss will be shown in profit and loss. Will be shown in profit and loss. 1,20,000. Is it over? Yes. Now we'll again come back to one paragraph which would be like a repetition. Net investment in foreign operation. Net investment in foreign operation. So these are basically long-term investments in a subsidiary where the repayment is not planned. It may be in the form of equity share, or it may be in the form of long-term loan whose repayment is not planned. The question now will arise how to deal with the exchange difference that will arise. So see the summary of all items relating to net investment now. Any monetary item receivable or payable to foreign operation for which settlement is not likely to happen in the foreseeable future is in substance, as per the standard, is like an equity investment in that foreign operation. Okay? So exchange difference arising on monetary item, like for example long-term loan. If you write the example, you will be able to understand better. So exchange difference arising on a monetary item. What can this monetary item? Loan to subsidiary. And it is a very long-term loan whose repayment is not likely to happen in the foreseeable future. That forms part of entity's investment in the foreign operation shall be recognized in profit or loss in the separate financial statement. Will be recognized in P&L account in the SFS when you are preparing SFS, because in SFS also I have to translate them. Am I right? Hello. In SFS, suppose this is the SFS. So on the asset side, you will have an item loan to S Limited, and then at the end of the year you have to translate it. So that difference will go to P&L account in SFS. But when you are preparing CFS, now see the note, technical way of writing, taken as it is from the standard without editing. In the financial statement that includes the foreign operation and the reporting entity. Which financials include foreign operation and reporting entity? CFS. For example, CFS, when the foreign operation is a subsidiary, okay, such exchange difference shall be recognized in OCI. In CFS, such exchange difference will be recognized in OCI and reclassified from equity to profit or loss on disposal of the net investment. This paragraph we have already seen earlier also. Exchange difference relating to net investment in foreign operation in CFS will be recognized in OCI. In SFS, in P&L account. What do you mean by net investment in foreign operation? So please write down there somewhere. Mathematically, it will be including investment in equity share plus long-term receivable and minus long-term payable. That is why the word used is net. Whenever the word net is used, it means there is something being deducted from something. Okay. So sometimes there can be reverse transaction also. You may have taken loan from the foreign operation. Okay, so now let us analyze when can we recognize exchange difference in OCI. Do you have any idea, some discussion on when will exchange difference recognize in OCI? If it is related to non-monetary items, whose gain or loss is recognized in OCI? This is one I remember. Anything else you remember? Net investment in foreign operation in CFS, exchange difference is recognized in OCI. Okay, anything else? Actuarial gain or loss? No, we are talking about only foreign exchange related. Actuarial gain or loss later. Huh? Functional currency to presentation currency. Correct. Then if there is a difference, that goes to OCI. Okay. Then translating financial statement of foreign operation into the presentation currency of reporting entity. Is it right? Any other situation? We have covered everything. These are the situations when we transfer the exchange difference to OCI. In other cases, it is transferred to profit and loss. All are reclassified. Yes. Except this non-monetary item whose gain or loss is recognized. Now again it depends on original item. Then net investment in foreign operation. This we have just now read. It is transferred to OCI. Then functional currency to presentation currency. Now there is no question of reclassification here. There is no question of reclassification because it is the same thing, only converted into a different currency. So it will remain there. And this will be translating financial statement of foreign operation. Now this to be discussed because it depends on whether control is lost or control is not lost. And again, it depends on whether that foreign operation is a subsidiary or associate or joint venture. So what will be the further treatment of this OCI item for the fourth type of situation to be discussed in disposal segment? When we will dispose, whether we will transfer to SFS, P&L account, whether we will transfer to NCI, that is also possible, whether we'll transfer to NCI. So that we'll discuss. So that is a little complicated part again, because they have created situations, and according to situations we will pass the entry on disposal. Right? Noted. This summary is something very interesting because very few books have given at one place which exchange difference will go to OCI. In fact, I have not come across any book so far which has given this summary at one place, which exchange difference in this chapter will go to OCI. Okay, the students are writing. Now we will take a break.